Welcome to this month's Economic Update. I'm Sinead, Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, a lot to talk about this month. October saw a lot of volatility in markets and falls in the share markets globally. Can you give us an understanding of what occurred?
We looked at the global share market. We had falls between minus 5% and a negative 10% type return. So if we looked at the Chinese share market down minus 9.6%, the NASDAQ, the US technology index, down 9.2%, the global share market itself down 6.9%, Australian shares down 6.2%, European shares down 5.6%. So very large falls. Now there's a combination of reasons for that. If we looked at it, higher American bond yields, so that has damaged Wall Street. We've also seen some earnings guidance from some of the technology companies, Amazon and Google, basically indicating that the profit outlook for future years is not as robust as what was previously expected. We've also had the trade war, so the tension between America and China about tariffs, that seems to be escalating. Italy's budget proposals are very contentious within Europe. So all these factors have weighed on global share markets.
Okay, so tell us a bit more about what happened in Australia.
We obviously fell with global share markets themselves, and all the sectors were down. So there wasn't anywhere to hide in terms of the Australian share market. So we saw that minus 6.2% negative return. And information technology, for example, fell 11%. Energy shares fell 10%. Consumer discretionary stocks, so they fell about 8%. So there was nowhere you could immune yourself from these falls apart from being in cash.
Despite that, a lot of the data, particularly out of the US, was quite positive. We saw the US unemployment rate fall further down to 3.7%. Are we finally starting to see some wage growth?
We have to bear in mind that the American economy is doing exceptionally well. Strong jobs growth, this low unemployment rate, which gives workers more bargaining power. And what we're now starting to see, they are pushing for higher wages. So wages growth now above 3% indicates future inflation risks. And because of that, we're seeing rising bond yields, and with that, a threat to Wall Street itself.
Bob, a further question that's more of a November event, but we had the US midterm elections and we saw some changes to the US House of Representatives. What do you think the impact might be on markets?
Yes, so this is a very interesting development with the Democrats taking control of the lower house, the House of Representatives, but the Republicans maintaining control of the upper house, the Senate. And this has important implications for the Trump administration because the lower house, the House of Representatives, that the Democrats now control, can launch inquiries into President Trump's past in terms of tax returns. It could also be canvassing the Mueller investigation into Russian collusion during the 2016 presidential election. So this makes it a much more difficult environment for President Trump in his last 2 years in office. And hence it also means that the potential changes in economic policy in the United States from a budget point of view are probably going to be limited. So we have essentially gridlock in Washington.
Thanks for your time, Bob, and thank you for joining us.